For more on what's ahead for Walmart, its competitors, and the outlook for consumers, let's bring in Bill Simon, the former Walmart U.S. CEO. He's now on the Darden Restaurants and Hanes Brands board, so you really got your pulse on the consumer. Bill, always good to see you. You know Walmart better than most people out there. What did you make of the guidance and their cautious commentary? It seems like they had to give that cautious commentary. I mean, we effectively got it from Target in the form of their very, very wide forecast for the current quarter.
Yeah, sure. I mean, I think the reaction in the market was a huge overreaction. It was probably an overreaction earlier in the week when they ran up, and certainly today. It was a good quarter for them and a cautious outlook, which is probably necessary because when you pull apart their report, a lot of their growth was in food inflation. They're still talking mid-single-digit grocery inflation, and that's what their food business was up. And so, you pull that out, they did really well in their health and wellness and pharmacy business, and then their broad lines, the hard line and soft line business was down, similar to Target, not as bad as Target, but similarly to Target. So I think, you're looking at a consumer who's starting to have to really, really be considerate of their purchases, which is indicative of us heading towards a downturn. In a recession, and you heard this in Walmart's announcement this morning, they buy deals. So Halloween was really good. The promotional period was really good, but it slowed down after that. My expectation is they'll have a pretty good Black Friday season. It's now elongated, but a pretty good Black Friday season, and it'll slow down a bit. And when the consumer gets stressed, they buy deals, and that's what we're seeing now, which is not a bad thing. Broadly, it's a good thing because it might indicate that the Fed's action is finally starting to slow things down enough so that inflation will cool.
Hey, Bill, it's Tim. So you've sat in the chair where, even though your daily job was to focus on the operations, you cared about the multiple of where your company traded. Walmart trades at a premium. Does it deserve that premium? And I talked about advertising. I talked about Walmart Plus. They've made a lot of investment in technology. And you say in your notes that investors kind of feel like they have to own Walmart if they're going to own something in retail. Why is that?
Well, I mean, they're a beast, right? And, just the size and the scale and the amount of investment that they've made in the last 10 years is astounding. I mean, they've grown their top line $100 billion in the last, say, 8 or 9 years, and actually have a lower operating income than they did 8 or 9 years ago. What that really equates to is just a massive change in the company, in the infrastructure, in their digital capacity, and the businesses that they're building. So, as a long run play, they're just going to be really, really difficult to beat. In the short run, you can bet against them. They're going to have to anniversary this food inflation and the growth that they've had from that, and that'll be a challenge. But in the long run, yeah, they probably do deserve to be an outside multiple.
Bill, you've talked about the self-inflicted wounds at Target for a while. Will this be the quarter when you look at operating margins came in much better, 5.2%, inventories down almost 14%, against sales growth of only down about 3%? Will this be the quarter we say that Target figured it out and that multiple should be obviously not a premium to Walmart, but it should start to catch up?
I do think so. I mean, look, Brian Cornell is a great retailer and he knows what he's doing. And, it was really encouraging to see them get their cost structure in line and to be able to sort of get that managed. And really now all they're waiting for is sales to return. And look, it's going to be hard to be as bad as they were over the last 12 months and the next 12 months. So they have much easier numbers to anniversary without all that inflation in it that Walmart does. So in the short run, I think Target's ready for a run.
Hey, Bill, we spent a lot of time obviously talking about Walmart and that grocery business. And, today it just kind of struck me. Kroger is trading at a new 52-week low, and it trades, at a multiple much lower than that of Walmart's. What's the read-through on that? The margin structure is not that different. It's a low-growth company, but, again, it trades really cheap to the market and many of its peers.
Yeah, I mean, look, Walmart is unique in that it's sort of woven together this grocery business, a general merchandise business, and a health and wellness business. So they're kind of CVS, Kroger, and Target combined. And what happens when one struggles, typically another piece of business sort of steps up and runs it, delivers for them. And if you look today in their release, I think they said their health and wellness business was, up high teens. I mean, that's just a monster number that Kroger doesn't have. And so Kroger's probably dealing with the food inflation and the traffic kind of transaction issues that Walmart is, but they don't have that big monster business and the margin that comes from the general merchandise. So I think that's the difference.